Morning, everybody. How's everyone feeling? Yeah? All right. Here we go. Huh? My son, it's not for me, it's for my son. I won't wear that. Okay. Right. Welcome, everybody, to the lending panel. We've got all the top people from this sector of the industry with us today. First time I think they've all been together. Hopefully no fights. So I'll just allow everyone to introduce themselves and where they're from, and I'll start throwing some questions out there. I don't know if in the agenda we had time for questions from the audience, but I think it'd be nice to fit it in if possible. So anyway, start with Zach.
Yeah, hi everybody. I'm Zack Prince, founder and CEO of BlockFi. Just a quick thanks to the Salt guys for sponsoring this panel, to Peter for moderating it, and to this crowd for all deciding to participate. I think debt and credit in the ecosystem is a trend that we're seeing accelerate and grow. It's a critical part of the financial services infrastructure for crypto assets, and it's exciting to get everybody who's a large participant in the market all in one place. And the panel is titled CryptoLend-O-Mania. So I just felt like I should say when we get started, let's get ready to rumble.
There you go. Hi, I'm James Alexander. I'm the Chief Capital Officer of Cred. And we have quite a panel assembled here. So thank you to the organizers, and special thanks to Salt, who's helping us build an asset class here. Like everybody on the stage, this is an opportunity to do things differently than have been done in financial services in the past, and we're really excited about that. And I consider everyone sitting up here to be my peer, not my competitor, as we're building an asset class, and it's early days, and so we should be collaborating to the extent we can. Ben?
Hey everybody, Ben Yablon, one of the founders of Salt. Really impressed to be on this stage in 2019. There's a feeling that's reminiscent of 2017. Like we need to engage with the fact that this is an exciting asset class. This is a special opportunity. Competition is fine, but we are the grizzled veterans of the crypto lending space, and there's not a company up here that's existed more than 3 years. That's an exciting thing. That's also a scary thing sometimes. And embracing an open format like this, where we can acknowledge and engage with the things we've done right and own the things that maybe we haven't, is really important. So really a big thank you to the rest of the industry for being willing to participate in a forum like this. And a special thank you to Peter for being willing to get up here and beat us all up a little bit. But be nice, okay?
No.
How you guys like Bitcoin back at 8,000?
Yeah.
So Celsius announced yesterday, we have over 200 million in deposits, and we've done $1.2 billion in loans. We're getting close to 3 million a day right now in deposits from over 120 countries. So the industry is back. I mean, it's crazy. And thanks for being on the panel, and love to share with you my thoughts on why we went down and why we're coming back up. So.
Hi, everyone. Anthony Trenchev from Nexo, co-founder and managing partner. Happy to be here. Thanks so much for organizing this, the guys at Salt, Peter for hosting this. All the other industry leaders that are sitting alongside here. Despite all our differences, we're in this together, especially after an excruciating year. Happy to be at 8,000 and, looking forward to what's up next. We're going much, much higher. And I'm just hoping we'll have a productive discussion which would benefit the audience more than the people sitting here. Thank you.
Great. So my name's Peter McCormack. I'm the host of the What Bitcoin Did podcast. Full disclosure, BlockFi are a sponsor of mine. So if they come out of this looking better than everyone else, that's the reason. And And also, just so you know my bias, I would say I'm very much a Bitcoiner and pretty much think everything else is terrible. So if that comes across during my questioning, there's a reason for it. So I'm going to start with Matt. You guys led the way. You pretty much created the industry. So can you tell us how Salt came to be, how you came up with the idea, and how you feel the industry has moved forward since? And then afterwards, every person can have a response to say, give their own feedback, and I think we'll just go down the line to begin with.
Sure. I'm Ben, not Matt.
Oh, I've got Matt written here.
I'm Ben.
I got the wrong list.
So on that note, again, Ben Yablon. SALT was a conversation that started in 2016 around the fact that there was no ability to lever crypto assets. There was a forced sale of those assets that triggered taxes and the loss of the upside potential of the asset, et cetera. So it became very apparent to the founders that there was a hole in the market. There was also no regulatory clarity around how you would deploy that product. It seemed like a simple thing, but there's a ton involved in making sense out of how you actually offer a lending product using crypto as the collateral type. And what that did was give us a first mover advantage to do something really exciting and really special for the market, but also force us to blaze that trail and to stamp down the weeds. And that was incredibly challenging. Took maximum effort from everybody involved in the project and still does. It's not done. We are not done. We are only just beginning to see what this market can really do. And the premise behind SALT was that Bitcoin would be the first collateral type, followed then by other tokenized forms of value, whether they be cryptocurrencies or tokenized securities, you name it. Anything on a blockchain would become a lendable asset. So the vision was for SALT to be a matching engine, so to speak, between different crypto assets, basically anything of value on a blockchain. And what's amazing is that here we are in 2019, and that's happening. We're watching all forms of value migrate onto blockchains. So that's where we see SALT going over the next 2 to 5 years, more on a tech play than necessarily a pure lender. So that's a long way of saying it's a work in progress. We don't know where this is going to end. There's the potential for collaboration. There's the potential for major competition. And I don't know that benefits the consumers as much as we would hope. I think that it hurts the industry in some ways to be in this sort of knife fight, this nonstop competitive mode, and that we need to look at ways that we can play together in the same sandbox.
So Alex, would you say that you guys can work together to grow the industry together rather than competing right now?
We'll see. We'll see how it comes out. But SALT may have started the lending business, but Celsius created the interest income business, right? We invented that. It didn't exist before. No one thought that you should earn income on your coins. And for every dollar in loan that we issue, we have probably $20 in deposits, right, that we take. So our lending business is probably, again, 5 to 10% of our business. 90% of our business is generating income for all of you to earn a return on your coins, right? So we have 18 coins, and we make those things earn between 5 and 8% per year. So I agree 100% with the other panelists that, the competition are the banks, the JP Morgans of the world, for example, who have 17 trillion in dollars, our dollars, and half of it they pay us nothing on. Half of all of their deposit they pay zero to all of us. So basically, we give them all of our money for free, right? They turn around, they lend it to our neighbor. They charge the neighbor 25% on their credit card, and they pay us less than 1%. I mean, that's just daytime robbery. And no one is doing anything about it. No one is doing anything about it. So that's my fight. That's the fight of my life, is to make sure that we can convince everybody on the planet, 7 billion people, to stop giving their money for free to the government or to the banks and deposit it in crypto and earn 7%. That's what we're focused on. The lending business is just another source of income for us.
Would you like to add anything?
Sure. Well, the team behind Nexo, we have been in the credit business for over a decade with another company of ours. We have been a fintech before the term fintech was even coined. Essentially what we do at Nexo is leverage that expertise to the blockchain space. And on the surface, it looks very simple. It's banking solutions for the blockchain space, whether it is active lending in fiat currency stablecoins, which is our bread and butter in excess of 90% of what we do, or what Celsius are doing with their, and BlockFi, by the way, and some of the other guys are doing with the earned interest products, interest-bearing accounts on crypto. It's essentially banking for the blockchain space. And that's on the surface, looks very simple, very straightforward. But I like to think of it as in another way, close to what Alex was just saying. It is also about social inclusion and banking the unbanked, because from a Western point of view, we're perfectly fine with the or to a certain extent, perfectly fine with our Bank of America accounts and JP Morgan accounts. We can move money freely around, and it's a no-brainer to us. But what we do is social inclusion, and these are large parts of the world where they do not have access to banks, to banking accounts, or are shut off from the credit system like entirely. And what we do is we provide a solution which is automated, is seamless, is flawless in that perspective that it doesn't require credit checks. There's no risk-based analysis of the whole process, and that is social inclusion, and that's going to be huge, especially so once we see the tokenization of the world, one of the bigger trends that I and the guys at Nexo are super excited about. And it's a social experiment. It's helping out the people of this world who do not have the privileges that we do, and it's a fight worth fighting, definitely.
Yeah, if I could jump in. So BlockFi has been around for a little over 2 years. I think in terms of starting to make US dollar loans secured by crypto, we started around the same time as Salt. My co-founder Florian and I come from the online lending industry here in the US prior to starting BlockFi. So I think we had a bit more of a eyes wide open approach to a couple of things in terms of the foundations of the business. And the first was in terms of regulation. So we spent the better part of the first 6 months since founding the company getting lending licenses, establishing partnerships with banks, figuring out our federal and state level regulatory framework, which enabled us to raise institutional capital, both in terms of equity for the company and also in terms of the capital that we're using to lend. And we were able to forego the ICO fundraising mechanism, which is something that is unique about us relative to others on the panel. And I think what you're going to start to see from participants over time is a bifurcation of the functionalities that are available on these different lending platforms. So BlockFi specifically will be offering things in the future. We have loans and the ability to earn interest now, but we'll also be offering things in the future like fiat on and off ramps and a credit card where you can earn Bitcoin rewards instead of airline miles or normal cash back. And in order to do those things, you need to have this connectivity into the traditional ecosystem, which is facilitated by your capital, your regulatory and compliance efforts. And so that's one of the things that I think we've done a little bit differently.
Want me to round that out? Okay. All right. Like Zach, I come from the online lending world, and I think two things really attracted me to lending and borrowing within crypto. One is the international nature of what we're doing. I mean, this is a truly global adventure. Like Alex, we have clients in 120 countries, which is really mind-blowing. And the other thing that attracted me is the collaborative nature of crypto. And it's a highly collaborative ecosystem, and it's something that at this stage in my career was really refreshing. Coming from financial services and traditional financial services, it's a really cutthroat business. So the opportunity to collaborate is really unique, and we should seize that opportunity. To continue that thought, our business model is really based on partnering and having formal integrations with the platforms we work with, which differentiates us, I think, from others. And it's probably slowed our growth, but we think that issuers and platforms that control large asset bases need to have a seat at the table when you're discussing liquidity. And when I say liquidity, I mean lending and borrowing. And I disagree with Zach, well, often, but on this particular topic, when it comes to bifurcation, I don't think we should be competing with our clients. I think we should fulfill a very specific purpose in collaboration with our partners. So that's sort of my line in the sand, if you will, in terms of differentiating.
Okay. So a common thing that comes up with especially Bitcoiners more than probably any other token holder is the term, not your keys, not your Bitcoin. And we've just discussed this, Zach. I put 20% of my Bitcoin into the BlockFi interest accounts to try it out, and I was happy to do that. But I got a lot of stick back from some Bitcoiners because it encourages people to give away their private keys. How do you feel about that? We'll start with you, Zach, because we've discussed this plenty of times.
Yeah, I mean, I think one of the unique things about Bitcoin is that you're able to self-custody large amounts of value. And I think that centralized solutions, whether that's exchanges or lending products, while they require that you give up the self-custody ability, they provide incremental services, for example, the ability to earn interest, which, or get a loan secured by your Bitcoin, which can create enough value to incentivize someone to give up self-custody. Or maybe you're someone who just doesn't feel like taking on the responsibility of self-custody yourself. And I think the key is for platforms to be thoughtful about how they're doing it. I think almost everyone on this panel custodies with a third party that has insurance and audits and great security systems in place to make sure that they're not at risk of being hacked or losing the funds of their clients.
Would anyone else like to add to that?
Sure. I always have something to say. So Not Your Keys is great for the first wave of the Bitcoin revolution. And I think we ran out of people that know how to store their keys, because if you're looking at the 21 million Bitcoins that we're supposed to mine over time, I can tell you right now that there's not going to be more than 15 million Bitcoin that ever going to be used, because the rest of the people already lost their keys, including Satoshi Nakamoto, who haven't used any of his 10 wallets once. Well, once, for the first transaction on the first block. But the point is that, you know, like if you read the Celsius paper from 2017, the white paper, you will see that our mission was to bring the next 100 million people into crypto. And if you want to bring these 100 million people, guess what? None of them know how to manage private keys, or at least most of them don't know. Why? Because all the people who do already got a wallet and already have a key. Now, you know, any of you use voice over IP? Anyone here? WhatsApp, Skype? Anyone? You used it 10 times today, you just don't know about it. Anyone knows how it works? Anyone here can raise their hand, say they know how it works? I guarantee you that if I sat down with you, I will show you that you don't know how it works. Okay? And the reason is because I invented it. I wrote the patents and the protocols. You can Google that, 1994. And if everybody who wanted to use voice over IP had to know how voice over IP works, then 3 billion people wouldn't be using it every day. The beauty of voice over IP is that you can take your phone, click on somebody's image, and you can talk to them. And that's a user experience that we have to deliver in the crypto world. So it took voice over IP 25 years to get there, right? And the last two companies, WhatsApp, Skype, really got it right In the process, 100 companies got it wrong, and it was a very, very long process. So my point here is that what we're trying to do with Celsius is create that user interface. We're trying to eliminate the need. If you're using our self-pay service or any of the other services, you'll see you don't need to know anything about keys, right? And the issue is not your keys. The issue is if we all just send coins to each other, Bitcoin is going to stay at 8 to 10,000. It's never going to go to where we want it to go. You want it to go to $1 million, you got to bring 1 billion people into this club. And they're not going to join if we all make it really, really hard for them to join. So right now, this is a very exclusive club, right? Anarchists, libertarians, right? Speculators, that's about it. And the institutions are not going to be the ones who are going to bail us out. The people who are going to bail us out and take this price higher are the billion people who actually need this, right? Who want this to pay bills or to store value or transact, right? And right now, we're not making it easy for them. So that's the key issue. The key issue is, are we working on this inclusion? Are we working on making it easy? Or are we just here to make a quick buck, turn around and sell it to someone else? Because if that's what we're doing, we're not going to change the world and make it a better place.
Ben, would you say...
Well, at least I have a few fans here, so...
Thank you. Ben, would you say that voice over IP is a fair analogy to managing keys with Bitcoin? Because if you don't understand voice over IP, you don't make a phone call or whatever. But if you don't understand your private keys, you potentially lose a lot of money. And also, do you not think in the world where we're trying to teach about self-sovereignty, people should learn about private keys and we should be educating people on this?
Yeah. So this is so timely. What Alex I think is driving at, and what we're all acutely aware of, is that crypto assets give us choice. We have the choice to hold these assets personally. We have the choice to store them with a custodian if we think that's the appropriate way to manage them. There are some regulatory requirements around using something like a qualified custodian. So when we're talking about the institutional side of the crypto space, there are actual regulatory requirements that some of these entities store the crypto either with a qualified custodian or become licensed as a qualified custodian, self-clearing broker-dealer, I think is the term of art there. But bottom line, these crypto assets can be treated like bearer bonds. They can be self-sovereign assets in their own right. They can also then be stored with custodians if that's the right use case. The point is you get to choose, and that has not existed in digital money before. This ability to make that decision, to take the ownership of these assets personally, is a huge deal. Do people widely have the ability to store their own personal keys in a safe and effective way? I think there's a learning curve there, and it's incumbent upon us as the leaders of this movement on crypto lending and crypto finance generally to help drive that education curve and give people the ability to store their own assets. SALT has been building custody from day one. We had to. In order to lend against these assets, you need to be able to store them securely. You need to not commingle them. You need separated accounts as a regulatory requirement. So in order to effectively, efficiently, and legally lend against these assets, they need to be stored in very specific ways. So we've had our eye on custody from the beginning. And that's a global conversation that the U.S. Market is in flux and will develop on its own cadence. There's nothing any of us can do about that. Other global markets are developing very quickly and are embracing the regulatory side of this and trying to make sense out of what smart regulation looks like that doesn't create some sort of risk for the jurisdiction. So we've seen really impressive initiatives there, and SALT has leaned into those initiatives, and we've been fortunate to help drive some of that global narrative.
James, how scary is custody when you're custodying hundreds of millions, perhaps billions in crypto? I would personally be panicking regularly most evenings about something going wrong because it is a huge honeypot. How scary is that, or has the industry matured so much that it isn't something you have to fear anymore?
Well, part of our responsibility in a new asset class, which this is to apply the hygiene of other financial services. And we're not the first people, to correct Alex here, he did not invent paying interest on assets. Unless you
Paying
invented the wheel
interest
also.
on crypto.
You did not invent that. It is a time-tested
I didn't invent VoIP
concept,
either, right?
okay?
Alex,
And
let's let him speak.
it's a time-tested concept, and the reason I mention that is not to provoke conflict, but that we should learn from history and we should learn from the institutional practices and apply those to this asset class. And so, bearer bonds or share certificates going back to the time of ticker tape and stock exchanges was an issue. That's still an issue today. Storing physical gold is an issue. And so we should learn from that and we should apply those custody, fiduciary responsibility, security, et cetera. We're not reinventing things here. We're trying to apply best practices. And in fact, a couple of us, Zach, Ben, myself, we've started to talk about sort of a bill of rights or best practices that everyone should be adopting. And I think in the spirit of transparency, that's really important to know what best practices are and who's adhering to those. So that would be my addition to this.
Can I respond to that?
No.
So
We would be surprised if you didn't.
let me respond to that. So
No, I have another question I want to ask. So, Anton, Alex mentioned wanting to bring in 1 billion people into the ecosystem, and James also talked about best practices. If we want to bring people in, do we need to have a more honest conversation about ICOs and token raises, and perhaps how a lot of people this is going to be their first introduction into the ecosystem, and a lot of people will have lost a lot of money doing this. Your company is providing tools to either borrow or create interest, but potentially in that process people have lost money in the ICOs. How do you feel about that?
Well, there's more than one road leading to any goal. So I cannot give you like a holistic answer at what should be the right approach, but I mean, ICOs and fundraising do have their place in the ecosystem. I am glad the way we conducted that, raising 52.5 million last year with the clear vision of using in excess of 90% of those funds so that they go back to the community in the form of loans, of low interest loans, so that we can make that social inclusion, banking the unbanked, etc., that we touched upon early on. I think there was a certain level of irrational exuberance, to quote Alan Greenspan. That has calmed down, and this was good. It is in the bear markets that great companies are built. It is in the aftermath of the dot-com bubble that the Googles and the PayPals and the Amazons and all these great companies, which are part of our everyday lives now, they were built exactly out of the ashes of the dot-com bubble. And at Nexo, this is precisely what we did. We focused on developing the best possible product as desired by our clients. And we are able to service clients in 200 jurisdictions, to provide our loans in 45 different fiat currencies. They receive their loans same or next day at the very latest, and developed a very smooth automated experience so everybody enjoys it. Right now, I think we are back to more traditional practices where you have to prove that your model works and there's a solid business case behind it so that you get financed. I think the ICO concept of money first, see what we're going to do later was crooked in a certain way. But of course, there are just 13% of the ICOs and the token selling companies that delivered their products. But I mean, I like to think that we at Nexo did our part of being the better example. Obviously, morals, moral codes and codes of conduct are something that we definitely welcome. We're just here to make everybody safe and the whole place and space being better off.
Okay. I'm not sure that completely answered my question, so I'll...
Well, there was a very elaborate question, but if you want to narrow it down, I can
Well,
give it
okay,
another go.
Zach, why did BlockFi not have an ICO? And why did you raise through the traditional route?
Yeah, I mean, I think there were two things. One was that we didn't feel like there was any need to have a token as part of the user experience, and the other was that we knew it was going to raise a lot of questions from institutional capital providers who we knew would be critical to building a business like ours at the scale that we strive to build it at down the road, and it carried more risks. I mean, we came into the market at the time, summer of 2017, when you could throw up a splash page and raise 30, 40, 50 million bucks. And in hindsight, not doing that has benefited us quite a bit. I think especially when you're dealing with financial services and you're, for example, giving someone an amount of collateral and they're then lending to you against that collateral, they're giving you less money than you're giving them. And so you have to have a level of trust there. And so we just didn't think it made any sense. We couldn't find a reason to have a token as part of our business. We thought it was going to be more of a ball and chain versus a business enabler. We had connections to raise institutional capital the traditional way, which we did from Fidelity, Galaxy Digital, Susquehanna, and others, and it's served us really well.
Alex, I imagine you have an opinion on this.
What was the question again?
So you've talked about wanting to bring 1 billion people into crypto,
Yes.
and I'm guilty of it myself, of being potentially misled on the potential of utility tokens and investing and losing money. Do you think that model now needs to die because it is kind of a disingenuous way of raising money?
Not at all. I think, Cred was talking about let's do what the institutions do. Let's bring the institutional way to crypto. If Satoshi was here, we asked him, what do you think about it, Mr. or Mrs. Satoshi? They would tell us, I created the Bitcoin to replace the institutional way, to replace the system that failed 90% of Americans and replace it with something that acts in the best interest of the people. That's the whole purpose of it. Now, if we want to bring all of this stuff that exists today on Wall Street, I'm part of the 0.1% of Americans. I came here as an immigrant with nothing, and I was very successful. I did 7 startups before Celsius, 3 billion in exits. You can look it up. All these companies are listed or available. You can audit me and see everything I've done. And I'm fighting for 80 or 90% of you who don't have that chance. And if we bring all of that institutional stuff into it, then all we're going to end up with the 1% controlling all your assets and not making you earn anything. So the opportunity, the promise of ICOs, the promise of this Cambrian explosion of innovation is all about inventing a new system that acts in our best interest. Now, many of these startups are going to fail. I can tell you, out of the 10,000 companies or so that were there during the internet boom, 95% of them don't exist today. All we got is 5 great companies, right? Facebook, Google, and so on, out of the entire internet, right? So if you're expecting the blockchain to deliver 10,000 great companies, then you don't understand how business works. So we had 2,000 ICOs. You're going to have 5, 6 great companies coming out of it. And you have to ask yourself, who is acting in your best interest? I can tell you that Celsius is the only company that I know, at least in this ICO clan, that gives 80% of what we create back to our customers, right?
Is that the ICO token holders or the customers?
Our depositors get 80% of whatever we generate. We don't charge any fees. We don't charge any termination fees, liquidation fees. How many people here are Celsius customers? Okay, did you guys ever pay a fee? Ever? Anything? So that's the idea. The whole idea is to do the opposite of what banks do, to unbank yourself, not to bring the banking model into crypto, or the institutional model into crypto. And the idea of a token is an idea of membership. It's the same thing like Costco. Anyone here is a Costco customer? You pay membership, and then you walk into a warehouse where you know that everything in that warehouse was curated for you in your best interest. You don't have to check the price of the orange juice or the toilet paper or anything. You can put everything you see into a giant, cart and walk it out, and you saved a lot of money or you made a lot of money, any way you want to look at it. That's what Celsius is. It's just a container that has financial products that always act in your best interest. And that's really the main difference. The main difference is that when we generate return or alpha, we give it to our depositors. When everybody here generate returns, they have to give it to their lenders. They have to give it to the shareholders. The same thing that JP Morgan does. JP Morgan, when they steal money from your bank account by charging you fees or lending your money at 25%, they give it to their shareholders. They give it to their executive members, right? So you have to ask really who's acting in your best interest. Who can you look? You live in New York City, who's acting in your best interest? Is anyone acting in your best interest? That's the problem we have in society.
I think you're deviating from the question.
Just to finish, the whole purpose of the token, and if you want to know how a token works, download the app and start using the Cell token. But the whole purpose of the token is to enable you to benefit from all these services, just like you buy a membership in Costco. So you want to create a service for 1 billion people? It's definitely not going to be a copy of JP Morgan or a copy of some other institution. You have to follow what Satoshi showed us the way. We either follow that or we let the traditional guys hijack the conversation and bring us back to where we are already.
I'm not sure Satoshi would be a fan of ICOs.
This is not about if ICOs delivered profits or not. The question is the business model of enabling the community to pick projects and decide what projects are the winning projects is the right model, or should we let the SEC decide for us what we should invest? How many people here got to participate in the A round of Facebook or Google?
I think we're deviating again here. It's not really what my question is.
No, but that's the point, right?
No, but Alex,
nobody gets to participate in any of these companies.
Of course, and I would love you to answer that question when I ask it, but the question was more about the value of the ICO, and I think your answer was the benefit people have deposits with Celsius have, which aren't.
Can I clarify?
I'm going to let somebody else speak, and maybe we can answer the actual question. In that, BlockFi have been able to provide this service without a token, and other companies have done it with a token. Now, I'm not having a go just for the token because I bought into them and believed into them once. But actually now, would the industry benefit from us stepping away from this ICO model? And perhaps, Ben, in hindsight, because you've had a lot of PR problems around your ICO, in hindsight, do you wish you had raised money in a different way?
No, definitely not.
Okay.
We correctly perceived that the market wanted the ability to participate in something new, that the old way of doing business was not sufficient for this crypto community. Alex said it earlier, actually it was Nuke. Nuke said, we're building flying cars and the regulators are talking about paving roads. We need to hand the community what they want. And at the time, when these decisions were made, that was something new, that was something interesting, that was something with a high degree of utility inside of the platform. It was also our ability to market ourselves and to push something out to the community that said salt on it, that you could hand to the next person and the next person after that. You could freely distribute this. In terms of its utility, it's a work in progress. I mean, we're still a startup. The funniest part of this conversation to me is this view of these companies and of SALT as some sort of institution. We are a startup. We're 2.5 years into this conversation. There will be pivots. There will be new decision matrix. There will be products that are scrapped. There will be products that are launched. Was it the right thing in 2017? Absolutely. Is it the right thing in 2019? I hope so. I'm trying. Let's make it cool again.
Okay, let's move on to another
Anybody want some salt?
James, how did the bear market impact your business, and have you seen any change in your business over the last kind of 2 months as it feels like the market bottomed out?
Well, these markets are incredibly volatile. I mean, I don't need to tell this room that. The bear market had a function, I would say, of sort of changing the focus from one side of the balance sheet to the other, so to speak. So, I think the emergence of people seeking yields is really the trend that we're seeing, less than levering up or borrowing against their assets. But that can change in a week. Look at the surge in Bitcoin recently. But I think it was unfortunate, and it feels like a healthier environment right now. That's the only comment I would make.
Anton, what are some of the biggest myths about the industry that are perpetuated by the media?
Misconceptions?
Yeah.
Well, there are a couple, definitely a couple. One would be that we are trying to replace the traditional banking sector with more of the same. We're not. We're definitely doing things in a better, more efficient way, and in a way which brings social inclusions and banks the unbanked, or unbanks those in need of being unbanked. But I would like to say something about the ICOs thing. This just bothers me. First of all, about Satoshi, you can have Satoshi as a beacon of hope and then as the guy who lost his private keys. I just wanted to get that out of the way.
We don't know what he did with his private keys.
Sorry?
Well, we don't know what he did with his private keys.
Well, that's what Alex said, that he lost the
We
private
might
keys.
find out in court soon.
All right. I feel personal.
I mean, I offered him 250,000 to.
You have a perspective on that?
I didn't say he lost his keys. I said that those
You
are
said
part
you're
of the
misplaced if you can't
part
trust
of
him with the
the
people.
6 million worth of Bitcoin that has not moved. So if you calculate how many coins have not moved, Satoshi's 10 wallets, which is now worth whatever, $16 billion, have not moved.
I don't think it's ever really healthy to speak for Satoshi.
My point exactly. And then with the ICOs, you got to figure out that these, the ICO participants are those people, these are the first customers, and this is incredibly valuable. This is a mechanism for customer acquisition in the most efficient way. And this is retail by the very essence and definition of it. So I think there's, the concept of the lending space, of what it's all about, is a misconception. There's a misconception of the whole ICO hype and what it is all about. And I think there's one of the larger misconceptions is about regulation, and this is what might cause headwinds going forward. This notion that the problems that are occurring are going to be matched by legislation and by regulation, and I think the exact opposite is true, or at least to the extent where the regulators are not necessarily the people who understand what blockchain and crypto is all about. These are three misconceptions that are there.
It's our job to educate them.
I agree.
Zach, when we first met, we had a long conversation about the future of banking and crypto. I personally look forward to a day where I have a bank account where I have my pound deposits and my Bitcoin deposits together, that I can fluidly move between the two and fluidly transfer money side by side. Where do you think we are in terms of that journey, and what are some of the most exciting products that you see coming in the future?
Yeah, I think we're really close. I would dispel this notion a little bit that we're creating something completely new, especially with financial services around crypto assets. But I do think that because we have blockchain payment rails, you have this ability to pick which jurisdiction you want to be regulated by or decide not to be regulated, and then deliver the financial services on a global scale that wasn't possible in traditional fintech or banking sectors because you were using payment rails that were heavily regulated. To answer your question, Peter, I think we're getting really close. I mean, there's already a few companies that, at least on the equity side of the equation, so for buying and selling, if you can get into the crypto world, then you have applications that will enable you to send it to your friends, buy and sell. I think there's still more work to be done on the connectivity side of it between fiat and crypto assets. I think there's still more work to be done in terms of incorporating the types of things that companies like ours are doing, so debt and credit, kind of a maturation of the financial services built in and around crypto assets. But the exciting thing is that, you know, any of us can make a loan to someone in Latin America secured by their Bitcoin at a really low interest rate. And that's something that wouldn't be possible if there wasn't this digital collateral type that we can all accept called Bitcoin. And the same thing on the interest side. You know, there's never been an interest rate market where a retail individual from Argentina, Japan, the US, Europe, Africa could get the same interest rates from a single company based on the same asset. And Bitcoin is what enables that to happen.
Alex, you have a long history of innovating with technology and companies. What would you like to see in this area of the industry to have a blur the lines more between the traditional financial markets and the crypto financial markets? Sorry.
Well, I can tell you that when I built the first VoIP gateway, I didn't go to AT&T and say, oh, let's all work on it together, kumbaya, let's keep charging people $3 a minute for their phone calls when they try to call their parents or their loved one overseas. This was war. It was about dismantling the TDM network and replacing it with VoIP. Now we're going from VoIP to MoIP, money over IP, and we have to dismantle the banks. I'm happy when I see, just like the phone companies, you know, AT&T used to have a giant building on Madison and 51st Street. Do you guys remember it? It's now the Sony building. They sold that building. Why did they sell it? Because they stopped stealing $3 a minute from you, you know? Same thing with the banks. We know we won when JP Morgan sells their building downtown, and you know that they don't have enough money to afford those buildings, right? That's what we need to do. So kumbaya, let's work together with the existing financial institutions. Fuck that.
Fuck the system.
Look, I disrupted. Another project I did was wireless in the subways. Okay, the city told me for 10 years, you can't put wireless. What if a terrorist comes and blows it up, right? I fought with the MTA for 10 years to get a license to put wireless in the subway. Anyone used wireless in the subway? You have 5 bars? Did somebody send you a bill? Anyone paid here for wireless in the subway? I got the phone companies to pay for it. And that's what we got to do here. We got to take the power and bring it back to the people, okay? Now again, I'm doing it because I'm an immigrant. I came with nothing. I went through years of not being able to pay my bills and not be able to pay my rent and worrying about how I'm going to make it out here and so on. So this is an opportunity to reinvent the system. This is an opportunity for all of us to take power back. Now, all you have to do is choose who you're depositing your money with. If you continue depositing it with banks, you will not change the system. If you continue depositing it with people that are not acting in your best interest, you're not going to change the system, okay? You just have to decide who is acting in your best interest.
I have a question for all of you. We'll start with Ben and we'll go down the line. It's a very simple question. Bitcoin or blockchain? I'll just say that I'm Bitcoin.
Right.
It's both, guys. It's definitely both. What Alex is saying is valid, but there's also a middle ground. There is a way to innovate from within those entities as well, and it's about the message, and it's about a compliance mindset. You can very definitely disrupt some of these traditional financial incumbents, but that's not really the promise of blockchain and Bitcoin. The promise of blockchain and Bitcoin is to almost infinitely expand the world of value. When we talk about the tokenization of value, we're talking about things like fine art, talking about the derivatives market. You're talking about anything of value recorded on a blockchain, and Bitcoin is there with it, and that's how Bitcoin goes to $1 million asset. So are you going to destroy JP Morgan? I sure hope not. I'd like to see JP Morgan innovate and become something new and valuable to us that is less painful.
Infiltrator.
Yeah. So Salt has always tried to walk the line between the traditional
Jamie Dimon's back there.
world. Jamie, walk the line between the traditional financial world and the crypto world and be that bridge. And you can't just break the world and expect good results.
I tried it a few times, worked out for me, you know. So,
So
let me
we
try.
agree to disagree.
We have so much
I
to
like
thank
Can I
you
answer
for.
that? I'll try to answer it. So, and I love Bitcoin, but unfortunately, I don't think it's going to be the winner. Just like, again, with VoIP, the fact that I wrote the protocol or built the first gateway,
Wait, did you invent VoIP?
yes, you can look it up. Didn't mean that I created WhatsApp or I created Skype, right? So the issue is when you
We have 10 minutes left, and I did want to offer the floor up. So can we
yeah,
keep
I'm gonna make it short.
Bitcoin or blockchain?
So I'm a big believer in Bitcoin. I think it's doing everything it promised. I said I'm going to explain what's happening right now. Right now is the first time that Bitcoin proved itself as a non-correlated asset. The reason it doubled is because everyone in the US is afraid of China and US going back and forth, is trying to park their dollars in Bitcoin. And you can see the price on Coinbase for the first time in 3 years higher than the price on Bitfinex, which tells you the money's coming from here, not from China. So Bitcoin is winning, but we need a much better solution, much bigger platform that can accommodate 7 billion people. So my view is that if we can come up with an open ledger consensus mechanism that is an open architecture, open blockchain, that will be the winning protocol, not necessarily Bitcoin.
Anton?
I think Bitcoin was the first killer app for the whole blockchain technology thing. And this is great, this is amazing, this is money of a new kind. I would also like to think that there are going to be a lot more other killer apps based on blockchain technology. My personal favorite and where I would bet my money on would be the tokenization of the world, of real world assets, because that is incredibly powerful. This is fractional ownership. This is redistribution of wealth in a most amazing way. So I would tend to say Bitcoin, but also blockchain.
Zach?
Yeah, I mean, in terms of assets that you can see on CoinMarketCap, for example, I think it's, Bitcoin, not blockchain, but I think there will be things that happen technologically with the blockchain that are largely still TBD at this point that will be really impactful as well. So I don't think you have to make a stark choice.
James?
Bitcoin, blockchain as a tool in the toolkit.
That's so on the fence. All right, listen, we've got 7 minutes left. I've got plenty more questions if required, but does anyone have a question? I saw your hand first. You might have to shout. Yes.
Okay, so this is a question for the people who give you interest on crypto. I mean, you give interest on crypto, so you need to get back from the other side from people borrowing crypto from you. And how do you manage risk there? In the recent run-up, you probably had the margin call of a lot of your borrowers. Could you give insight to the audience on how you manage risk?
We'll start with Zach. Did you hear that question?
Yeah, no, I heard it just fine. So we're using the same risk management system that's been in production since January of 2018, managing risk on the USD lending side of our operation. So as a general rule, positions are over-collateralized, and then what our risk management system does is it looks at those positions and takes certain actions based on the values of each position, which could be notification, it could be margin call, it could be use collateral that was posted for that loan to either buy an asset or sell an asset. And I'm happy to say that performance both on the USD and crypto lending side for BlockFi has been perfect since inception. We've never had a late payment, a loss of funds, a default, or anything like that. There's another important element to that risk management framework, and it's your counterparty credit analysis. So when you're lending crypto, you're primarily, or at least we are exclusively lending it to institutional borrowers. And so in addition to taking collateral when necessary, you need to have a view on what level of risk you're taking by facing that counterparty, because someone could do something illegal and have their funds seized. They could file bankruptcy. So you need to have a strong framework and level of underwriting know-how to evaluate that corporate risk in addition to just the price risk of the value of the assets that they borrowed relative to collateral that they posted.
Does anyone have a...
Is the question more about, well, so there's a surge in the price higher, so it's really dangerous for the shorts. So I think that's the question. Is that correct?
Yeah.
Yeah.
If you give interest on crypto, then the people...
Right, you have to redeliver that crypto. Yeah. I mean, that's a very good, and it's a timely question given the surge in a lot of these assets. I mean, from Cred's perspective, we made a decision, a fundamental business decision, not to lend to shorts. Now, although it's impossible to track every token, if you come to me and say, I want to borrow some Bitcoin because I'm going to go short it, the answer is no. And that is a timely question now, to Zach's point, who are your counterparties? And are they able to redeliver that token? And I think that's a legitimate question to ask when you're entrusting your assets to someone.
Somebody else had
So,
that.
can I just add to that for a second?
Alex, we've got to get through
There's a
more questions.
misnomer about what this is used for. And most of our loans, over $1 billion of our loans, have nothing to do with shorting.
Thank you.
It has to
Alex,
do with
they have to
market
do with?
making, where there's arbitrage between pricing and the borrower, in this case a hedge fund or an institution or an exchange, just trying to capture that value, and they don't want exposure to the underlying assets because our
Alex, we
depositors.
have limited time. I want to let
Right.
other people ask
Go ahead.
questions. Yes, sir.
So this is a question for all of you guys, right?
We won't have time for all of you, so pick one.
Okay, yeah, so, the fundamental value of a bank is custodian, borrowing, and lending. And this is basically what every single one of the startups here are doing, right? So you're essentially building banks, but for Bitcoin.
Woo!
Yeah, that sounds like the first line in our investor pitch deck right now. It's a modern banking company that's crypto first.
Let's hear the
It's all the
question.
same stuff.
So the question is, it's like kind of like building taxi companies, but for Uber. It's Bitcoin is built to be unbanking, right? It's built to get rid of the lending, borrowing, the traditional capital market, the way it works. But you're essentially building something that's not Bitcoin.
Okay, yeah.
Yeah.
No, but
Can we keep
these
it
are-
short? 'Cause of
Yeah,
Mission O'Clock.
I'm going to keep it short. These are supplementary services. Like with Nexo, the very essence and the idea was how do we give people the means to spend the value of their crypto without selling it, essentially giving them the best of both worlds. You keep your Bitcoin, but you tap into the liquidity and you pay your bills, you go on vacation, you buy a house like we did with Brock Pierce. He borrowed against his Bitcoin from us to execute the world's first crypto mortgage. So it's a different use case. It's supplementary on what Bitcoin is all about. It's not conflict there.
So we have time
Our
for
slogan
one
is
more
unbank
question.
yourself.
Alex,
Just
we have time for
stop
Alex.
there.
Alex, I will take your mic off you. We have time for one more
I have this
question.
one too.
Yes.
Yes, still about the interest rate. So this question is for Zach. According to the traditional finance theory, interest rate is the short-term interest rate is defined by the monetary policy. Is defined by the Federal Reserve. So, but in this area, no institution can define this short-term interest rate. For long-term interest rate, it's defined by the demand and the supply. So in this area, still until now, we cannot use cryptos in every business. So how to define this, or how to price this interest rate?
Yeah, that's a great question. I think there's a couple of facets to it. So if you look at an analogy of the gold market, there used to be what was called the gold forward rate, and it's starting to come back around. So one of the first places we look to benchmark rates is in the various futures markets that operate. If the futures market is in contango, which happens when sentiment is very bullish and the futures price is higher than the current spot price, then you cannot derive an interest rate from that channel. So what you're left with is benchmarks, for example, from margin lending that happens on exchanges, or just general market connectivity that you have as a lending business like we do. And you see some distortion in the rates that are offered to retail investors in terms of earning interest relative to the actual rates that occur in the market if you're comparing those metrics. And that happens because companies like ours are incentivized to acquire customers. And so the same way that a bank would offer you $250 to sign up for a new checking account with them, that same type of thing can happen with the financials of companies that are operating in the interest payment space.
Right, we've hit our limit. I just want to say thank you to everyone on the panel, every one of you who've come in, those who asked questions. Can we have just a warm round of applause?
Thanks, Peter. Appreciate you doing that.
Yeah, welcome.